This is Michael Lukes from the Kahuna Accounting team, and this week for the Accounting Clarity for Entrepreneurs series, we're going to be talking about the basics and the importance of gross margins for your business. I know it doesn't sound too exciting, but trust me, this is really important stuff, and it will be a lot of fun. So gross margins, which are also known as gross profit margins, is the percentage of revenue you keep after cost of goods sold. We're going to calculate a gross margin and explain a couple of important things to know about your gross margin using an example of a service-based business. First, we're going to locate your gross profit margin using Zero Cloud accounting software. Here it's referred to simply as gross profit. For those of you not using Zero, please don't worry. We will do an example without using the software that will help you calculate your margin, even if you want to use a piece of paper and a pen instead of the software. When looking at your dashboard, you want to scroll over to Reports and click on your income statement. Gross profit margin, since it's related to your business's income, will always be found on the income statement. You will find your gross profit amount located right above operating expenses. Remember that this number is your sales subtracted by costs of goods sold. Finding the percentage of your gross profit margin will tell you how expensive each dollar of sales is before your fixed expenses, shown here as your operating expenses. This is extremely valuable information because it shows you how profitable your business is per each dollar of sales. Even a slight increase in your profit margin can have an explosive impact on your company's growth, and we will touch on that here in a minute. So before we move on to our detailed example, let's calculate the gross profit margin percentage for this demo company you're viewing right here. To find that percentage, we need to subtract costs of goods sold from revenue, which is $1,168.74. We then take that number and divide it by our revenues of $2,008.74 and multiply that by 100 to get our percentage. This comes to 58.18%, which means for every dollar in sales, the company's gross profit is 58 cents before that amount is applied to cover operating expense. So when all of your operating expenses are covered, every additional dollar in sales will bring just over 58 cents in profit to your company. To further illustrate gross profit margins, we made up a company called Solo Graphic Design Company. It's currently a one-person agency that creates logos for companies. They charge a flat rate of just $25 a logo and spend an average of 20 minutes on each job, meaning this entrepreneur can create 3 logos in an hour to earn a total in $75 in revenue. Now looking at their fees, they pay $5 per job to the website they market their services on and pay $200 in additional advertising per month and a fixed internet cost of $100 per month. Now we're going to get into the fun stuff, the gross profit margin for Solo Graphic Design Company. We're going to use 1 week's worth of work as an example. The founder of Solo Graphic Design worked 33 and 1/3 hours and was able to complete 100 jobs in total. Their total revenue was $2,500 for the week. To get the gross profit margin, we have to subtract the costs of goods sold. So for simplicity here, we're going to break down a single job, which they can do 3 of in an hour, to calculate the gross profit margin. As shown in the previous slide, there's that 20% fee associated with each sale. So that $5 goes into the cost of goods sold. Since the owner of the company does need some money to survive on, they charge $25 an hour for direct labor, meaning that since this work results in the owner needing to get paid this amount, it will be recorded as part of cost of goods sold and not operating expense. If he or she had an administrative assistant, for example, that would go into operating expenses and not be part of cost of goods sold. So since we're calculating the gross profit margin of a single sale, and there are 3 sales in an hour, the direct labor cost for this one sale is $8.33, making for a total of $13.33 of variable cost for each logo sale. That means the rest of the $25 is going to go towards your gross profit margin. So we plug in our formula to get the gross margin percentage, which is revenue minus cost of goods sold divided by revenue and multiplied by 100. We get 46.68%, which means that for every dollar Solo Graphic Design Company earns from sales, nearly 47 cents goes to profit margin before paying the operating expenses. Looking at the entire week for the company, you can multiply total revenue, which is $2,500, by the gross profit margin, which would be 0.4668, and you see that gross profit before operating expenses is $1,167. Now we want to keep this lesson fairly short, but before we go, we're going to show you a quick example of how knowing your margins and this percentage can help you grow your business. This is where it gets extremely fun for us entrepreneurs who want to see more money coming into our pockets each month. I was really blown away by this. So remember that 20% of each of your sales in this scenario is subtracted as a fee. So for this business, that fee comes from using the back end of a freelance website. I used to provide my own services on a website like this that did charge 20%, which is a pretty hefty fee. The founder of Solo Graphic Design decides he or she wants to search for other providers and finds a similar one that charges that 12.5% instead of 20% from every sale. Now, instead of taking $5 from every sale, just $3.12 is being taken as the fee for each sale. It seems like a pretty small change. I mean, what's $1.87.5? But let's look at our profit margin and what this does to our weekly gross profit margins. Now, on the left-hand side is the old profit margin information, and on the right is the new one with the lower fee taken out of each sale. The change shifts the variable cost per job from $13.33 to $11.45.5. And after we plug this information into our equation, we see that our gross profit margin goes up from that 46.68% to 54.18%. So what does this mean for our weekly sales? It means we take home a gross profit of $1,354.50 instead of $1,167. To sum this lesson up, a small change in your profit margin can have a significant impact on your profit. We often think that the only way to bring in more money is to increase our sales, but that's simply not true. In this scenario, we didn't add one sale to our equation, but by lowering just one of our fees, we increased yearly sales nearly 14%, which for the small business would be a difference of nearly $10,000. Your to-do from this lesson is to calculate your profit margin and then look carefully through the expenses that are part of your cost of goods sold. Is there anything you can decrease to increase your profit margin? It's very likely that there is some expense from cost of goods sold that you can decrease. And now we reach our final question. So without decreasing the cost of goods sold in this scenario that we just went through, Solo Graphic Design Company, how many additional sales would Solo Graphic Design need to make that $10,000 in additional gross profit that they made by just lowering their costs? 857 sales would be needed to make up that $10,000 that was created just by lowering the cost from that 20% to 12.5%. And since the founder of the company can only complete 3 an hour, that means he or she would need to work nearly 286 more hours to make the same amount of profit that they could make by lowering that one cost. We'd like to thank you for joining us today. Once again, this was Michael Lukes with Kahuna Accounting. We're having a lot of fun working with our accounting staff to answer these questions for you and help entrepreneurs grow their business using bookkeeping and accounting. If you're interested in learning more about Kahuna Accounting, please visit kahunaaccounting.com. We work with companies that want to grow, and we are truly dedicated to serving entrepreneurs. If you have an accounting or bookkeeping question related to your business, please feel free to send it to me at michael@kahunaworld.com. That's MICHAEL at kahunaworld.com. This has been the 4th tutorial in the Accounting Clarity for Entrepreneurs series. Thanks again.